Afcom Holdings Q2 financial year 26. Earnings: a small cargo airline, just 2 planes, and revenue grew by nearly 144% in a single year. Net profit: up 230%. EBITDA margin: above 40%. This is not Indigo. This is not Air India. This is Afcom Holdings, India's dedicated freighter airline, and their FY26 earnings call had some truly fascinating things to unpack. Today, we're breaking down the entire concall, financials, fleet expansion, fuel costs, and future guidance, all in simple, straightforward language. Let's get into it. First is company background. Afcom Holdings is a dedicated air cargo airline that primarily operates across the ASEAN region, Maldives, Sri Lanka, and the Middle East. They currently operate 3 aircraft, Boeing 737-800 freighters. Their base is Chennai Airport, and they are a listed company on the NSE and BSE. Their USP? Fast, flexible cargo solutions, especially short-notice charters that belly cargo airlines simply cannot offer. Now, let's get to the numbers as we look into Q4 financial year 26. Numbers are like this: revenue, 191.88 crore rupees, 87.8% growth year-on-year. EBITDA, 74.08 crore rupees, 51.52% growth. YoY net profit, 44.66 crore rupees, 72.85% growth YoY. And that's just one quarter. Now look at the full year FY26 numbers. Revenue, 587.72 crore rupees, 143.86% growth. In March 2026, the Middle East conflict caused a large number of airlines to suddenly suspend their scheduled operations, especially those flying out of the Middle East. The result? Stranded cargo and a massive demand spike for air freight. Afcom seized this opportunity and ran multiple short charters: Chennai to Colombo, Colombo to Malé, Chennai to Malé, essentially moving all the cargo that had been stuck across the region. In Q4, out of their 602 total trips, 415 were pure charters. March's revenue alone was 22 to 23% higher than the January to February average, purely due to this surge. And management was clear. This wasn't just a temporary blip. The underlying demand was already strong before the war boosted it further. Moving on to operational metrics. Here are some key operational numbers you should know. Full year FY26 operations. Total trips, 1,923. Total volume handled, 24,353 tons. Pure charters, 1,129. Average revenue per trip, $31,243. Average yield per kilogram, $2.54. Weekly trips per aircraft, 19 cost per kilogram, $1.58. Aircraft utilization, peak utilization, 11.45 hours per day per aircraft. Industry best, FedEx/DHL, 10 to 14 hours per day. Asia Pacific average, 7.9 hours per day. Afcom, sitting between Asia Pacific average and industry best. Their full-year capacity utilization stood at 81.42%, which is already a very healthy number. Next is fuel cost. The biggest concern on every investor's mind: aviation turbine fuel prices jumped over 100% from April onwards. Up until March 31st, fuel was priced at 85,000 rupees per kiloliter. On April 1st, it spiked to 224,000 rupees per kiloliter. That was the elephant in the room. So how did Afcom handle it? Fuel cost is 100% passed through to the customer via a fuel surcharge added directly to freight charges. This is standard industry practice, exactly like the fuel surcharge you see on airline tickets. They received designated Indian carrier status, which meant they got fuel at 1,69,000 rupees per kiloliter instead of 2,24,000 rupees, a direct saving of 55,000 rupees per kiloliter. Sea freight has also become expensive due to the Red Sea and Persian Gulf disruptions, so customers had no real alternative to air freight anyway. Fuel prices eased in May, eased further in June, and management expects them to settle at a reasonable level by next quarter. Bottom line, margins are protected, no impact on profitability. Now here's the most exciting part, fleet expansion. Afcom currently has 3 aircraft, Boeing 737-800 freighters. Here's the roadmap, near term, before Q1 FY 27 ends, aircraft 4 and 5, both Boeing 737-800s, will be inducted. They are currently on the way by end of calendar year 2026. First Boeing 777 wide-body freighter inducted by FY 27 last quarter, March 2027. At least one B777 fully operational full fleet target mid-calendar year 2027. Total 9 aircraft, 5 narrow-body plus 4 Boeing 777 wide-bodies. Financial closure for all 4 B777s is already done. Funds raised through QIB plus preferential allotment. No further fundraise required. What does the B777 mean for revenues? Capacity is 5 times more than the 737 conservative revenue estimate, 75 crore rupees per aircraft per month. Management explicitly called this conservative. Actual numbers could be higher. Quick balance sheet snapshot. Total equity, 457 crore rupees. Total assets, 935 crore rupees. Cash flow from operations, positive 36 crore rupees, turned positive this year, a big milestone. Return on equity, 26.69%. Return on capital employed, 35.62%. EPS, 48 rupees and 65 pies. One important note, results are now reported under INDAS accounting standards. This means lease assets and liabilities are shown separately, ROU, right of use. Assets are classified differently. So when comparing with older numbers, keep this accounting shift in mind. Trade receivables, 60 days, well within control. No outstanding dues older than 6 months. Let's discuss new routes and business developments. Afcom isn't just expanding its fleet, it's expanding its geographic footprint too. Middle East operations live. Direct flights from Dubai, Sri Lanka and Maldives. Dry lease operations underway Nauru Air Corporation, Republic of Nauru. Strategic partnership. Entry into Australia and Pacific region Noida Airport. Afcom will be the first cargo aircraft to land at the new cargo terminal. Inaugurated June 17th, Delhi and Mumbai. International operations planned MRO, maintenance, repair and overhaul. Momentum picks up from next quarter with plans to open it up to third-party aircraft as well. Here's a data point worth highlighting. Chennai Airport's international cargo growth was 12.5% year-on-year. All India average international cargo growth, just 5.4%. Chennai outperformed the national average by 2.3 times. And management's take, Afcom is the primary driver of this growth given that Chennai is their home base. Now, for the honest part, what are the concerns? 1. History of fleet delays. Original guidance for FY26 was 1,000 crore rupees revenue, then revised down to 700 crore rupees. Actual came in at 583 crore rupees. Aircraft induction delays were the primary reason. 2. Advance tax not fully paid. Investors flagged that out of 36 crore rupees in current tax, 33 crore rupees was still outstanding. The interest on this is non-tax deductible, effectively costing 16 to 17%. Management acknowledged the issue and committed to addressing it this year. 3. War dependency. A significant portion of Q4's upside came from war-driven demand. If peace is restored, freight rates will normalize, though management argues prices won't fall back to pre-war levels, drawing a parallel with how post-COVID freight rates settled permanently higher than before. 4. Execution risk. 9 aircraft fleet, 4 wide bodies, new routes, MRO setup, Nauru JV. A lot is happening simultaneously. Flawless execution will be critical. So here's the summary on Afcom Holdings. Phenomenal FY26 growth, 143% revenue, 230% profit, achieved with just 2 aircraft. Q4 got an additional war-driven demand boost. Fuel costs are fully passed through. Margins are protected. Fleet expanding from 3 to 9 aircraft by mid-2027. Boeing 777 wide bodies expected to generate 3 times revenue per aircraft versus current levels. Balance sheet is strong, cash flow is positive, no more fundraising needed. New routes, Middle East, Noida, Delhi, Mumbai, Pacific watch out for, execution delays, post-war demand, normalization, and advanced tax management. This is a high-growth, high-execution risk company. If the fleet expansion happens on schedule and demand stays strong, the numbers could shock once again. Is this your first time hearing about Afcom? Drop a comment below. If this breakdown was useful, hit the like button and subscribe. More detailed concall breakdowns are coming your way. Disclaimer, this is purely educational content. It is not investment advice. Please do your own research before making any financial decisions.